There's a lot of volatility in markets, but how do you create consistent retirement income with volatility? Give me a second, I'll be right back. So if you've turned on the TV or been on your computer or even your phone, you know there's lots of volatility in markets right now. You know it's got a lot to do with the tariffs, and you know that there's just a lot going on and it's probably impacting your portfolio. If you're retired or close to it, you're probably even more concerned because you're going to try to derive income off of the portfolio. And one of the biggest issues when it comes to taking money out of an account that you've been putting money into all of this time is something called sequence of returns risk. In other words, the return on your portfolio and in what year did you get that particular return. Let me put it a little bit differently. Let's say that you're stepping into retirement and you had $1 million in your portfolio, and as soon as you step into retirement, the market drops 50%. First year out. So you went from $1 million in your portfolio to $500,000 in your portfolio, and you've got half the money, which means, let's say that you could get a return of 5% per year. Well, 5% on $1 million is $50,000 a year. 5% on $500,000 is $25,000 a year. You have half the money, you have half the income. And if that sequence of returns means in the first few years you get terrible market returns, it'll be very, very hard to recover throughout retirement because how's the money going to get back in there? The opposite of that is, what if the returns were very, very good the first few years of retirement? Well, then you really wouldn't have much to worry about if later on markets were bad because you already got the money up front. So that's a sequence of returns. What's interesting is if I showed you a portfolio over 10 years that had an average rate of return of, let's say, 10% per year, and I took those returns year over year and then I turned them upside down to where the returns were reversed, you would get the exact same average rate of return over the same period of time, but your income or the amount of income you could derive from the portfolio would be very different. So we have to find a way to control the income in the portfolio while also having growth in portfolios in order to offset things in the future like inflation. There are many ways to do this, but the sequence of the returns in your portfolio is going to be critical when it comes to income off of your portfolio. So because of this and the concerns over the sequence of the returns in portfolios, many people start to look for what are the sources of income and what are quote unquote potentially guaranteed sources of income or alternatives to guaranteed sources of income. Any true fiduciary should be able to walk you through all of the options to help you make an informed decision. But let's just go through a couple. First of all, you're probably going to have Social Security income. So let's take that as a guaranteed source of income. I know not everybody thinks it's going to be guaranteed forever, but for now, let's use Social Security. Many of you might have pensions, so let's add that in the guaranteed column. Some people have other sources of income like real estate income, maybe you have farm income, just depends on where it's coming from. But when we put together a comprehensive financial plan for individuals, one of the questions that we're going to ask is, how much money do you need to maintain your standard of living in retirement? Now that number is going to be a little bit different for everyone, but let's just say for you it was $10,000 a month. I want to be able to spend that much to maintain my standard of living, and then I need to increase that over the years because of inflation. Now $10,000 a month to spend is not the same as $10,000 a month in income. So in order to get $10,000 a month to spend, you have to actually make more than the $10,000 a month so that after taxes, federal, potentially state tax, inflation, you can actually spend that much. So how do we get to that number? Well, if your Social Security numbers plus let's say a pension number, let's say that gets you to $6,000 of the $10,000. Now you got to bridge that gap of the extra $4,000 to get to the $10,000. Where does that come from? It comes from your portfolio. So now you're looking at your portfolio going, how do I get $4,000 per month after taxes, after inflation, to spend to get me to $10,000. Now, the first thing it's going to depend on is how much money do you have in your portfolio, right, to derive that return. But it's always going to come back to the sequence of returns. So let's look at options that are available. Now, if you've watched any of our YouTube videos, you'll be familiar that we're not big fans of annuity products. Many advisors sell annuities to bridge that gap for income because it's promoted as guaranteed income. The problem, in our opinion, with most of these accounts, I haven't seen one that doesn't do this, is that as you're taking the income from the annuity, you're actually spending your principal. So I really don't like the fact that they call it guaranteed income, because I define income as I made money and I'm spending the money I make. The majority of these annuity income products, they're guaranteeing you income, but they're just paying you out of your own pocket as your principal goes down. And unfortunately, too often in the sales process, the advisors, at least in my experience, have let people believe that they're actually making money and they don't want to talk about what happens to the principal. So if you don't want to be in a situation where you're taking income to bridge the gap and reducing your principal, you want investment options that actually help you preserve principal and get income so it's still there at the end. I think you should look at things like structured notes, because structured notes can provide income while also providing protection from market volatility. You could also look at dividend portfolios. So buy companies that pay dividends. Yes, there's going to be volatility in the market, but you can a lot of times not worry as much about the sequence of returns because you're getting income and you can wait for markets to come back while getting income. Other thing you might look at is don't have all of your money in the market. Have a certain amount of money not in the market that you can withdraw from so that you don't have to pull money out of the market when it's down. Bottom line, there are many strategies to help you as long as you're doing it correctly in portfolios and you understand what all of your investment options are. Many advisors will try to steer you to what their company is promoting, but that's not educating you on all of your options. Sit down with somebody who's going to explain all of the options, find out what's best for you by looking at those options and making informed decisions. So many advisors will use what's called a bucket strategy. I'm okay with the bucket strategy, but too often it gets used in different ways. I don't like the bucket strategy when it applies to annuities. You may have heard about this. Many advisors will use it. They'll talk about it in seminars. You've got this bucket over here that you spend down. You've got this bucket that you'll take income from later, and you've got this bucket that eventually goes to beneficiaries. I've literally never seen one of those strategies that actually works. I know they say it works, but a lot of times they're let's just say fudging the numbers and implying that something's going to do something that it is not. So I don't like that strategy. If we look at, I think, a more appropriate bucket strategy, what we would say is you have money that's not in the market. That's the money that you can always go to in case the market's down, right? So think of it as cash at a high interest rate that you have access to. Then you've got that bucket over there. Now let's have something that will provide the actual income in your portfolio. So I was having a conversation with a client the other week. They came to me and they said, hey, Mike, I need to generate $40,000 a year off of my portfolio. What are my options? So we sat down and we went through all of the options that are available. In their situation, they decided that structured notes would be most appropriate for them because what we were able to design would give them protection from market volatility, would also provide protections on the principal investment under certain circumstances, but at the same time provide the income. So we were able to derive that additional $40,000 in income off of their portfolio while having provisions to protect the principal investment and also let the other investments or other bucket of money that's in the market grow. And that third bucket that's growing can do things like not only provide income in the future, also provide protection against inflation because you need your money growing. Things are going to be more expensive in the future. And we just want to have all of these buckets working together as a strategy that long-term helps you be successful in retirement. And I would define success as being able to maintain the standard of living that you want regardless of how long you live, and that means not running out of money. Thank you for watching. Go to guardingyournestegg.com for your free and objective personal financial plan.